Hello. Today, Lex and Mark's internet is out, which means you are stuck with me for 5, 10 minutes, however long I can go on talking to myself. I'm feeling so lonely, so come ask me questions. Today, I am going to talk about historical volatility and implied volatility, and then I'm going to show the implications on Voland. So I don't have a bell, so I'm just going to say ding. Hello, everybody, and welcome to the Brew with me, Jason DiLorenzo, the Wizard of Ops. Lex and Mark are not here, so today I'm going to get to talk about vol. I get to talk about whatever I want. So ask me questions. We could do a little AMA toward the end, and maybe we can extend the show to get it to a half hour if you guys have questions about anything. Doesn't even have to be about vol. Just don't make it about wine. I'm not the wine expert on this show. So, all right. So I am going to show the implied volatility and historical volatility chart courtesy of Trade Alert, because Trade Alert with CVOE has a lot of great info, and I think that this is just one of their charts, but they have a lot of great info for options. So this chart you can see here on the this right here, the legend is showing the comparison between implied volatility, the I vols, and the historical volatility, the H vols. And the number is how many days they're taking the average of, the annualized average of. So this is 1 month, 2 month, 3 month, 4 month, etc. Okay. Over the past several days, over the past week or two, we've had a lot of heartache a little bit about the Japanese intervention in the yen and the dollar. We've had some heartburn over Fed speak, and bonds have sold off like crazy. So there has been a lot of, I guess you could say, a little bit of heartburn in the equities market. We've kind of dropped several percentage points. But it's been kind of measured, though. I mean, other than a couple 70-point days, I think it's been, mostly measured. But historical volatility has shown that. So if we take a look, all the historical volatility lines, starting around 21 September, when I started harping about this, has stayed relatively low. These percentages in this box here are showing an annualized percentage of what the historical volatility has been over that time period. So if you basically extrapolated the 30 days of historical volatility over a total year, you would get an expected one standard deviation movement of 11.61, which means there's about a 2/3 chance that the market would move 11.61% or less. So you can see all the historical volatilities there are in that, between very close together in that 11.5 range or so. Yet you see implied volatilities have started to take off, starting in 19 September up to 21 September when the market started really dropping. And we've gone all the way up to 17, 18. Now, these are the way Trade Alert uses is they use an at-the-money implied volatility measure. So whatever the 50 delta is, or the closest to 50 delta, that's the implied volatility they're using. So this is going to be a little bit lower than VIX, which has a kind of a skew component to it. So implied volatility is between 17.5 to 18. So it's kind of interesting that even though historical volatility is kind of showing, still kind of small numbers, in that 10, 11 range, implied volatility is all the way up to 17 or so. And you can see historically it's supposed to be a lot closer. It's supposed to be, 1, 2%. Around here, I was expecting kind of a little bit of a drop. But now I'm getting kind of concerned that implied volatility has gotten ahead of itself. If nothing happens, like, these macro things with the Bank of Japan or, these job data that's coming tomorrow, or the FOMC higher for longer kind of stance. If nothing, happens immediately, I think that we could have an implied volatility drop to get closer to historical volatility. And so, Max, if I can now share my Volin screen. Let me stop sharing this and then share Volin. I will show you what I mean. Okay. Sorry, dead air. Dead air. This is what happens when you're all alone. You get dead air. People start walking away. See, this is why maybe I'm not made for TV. I don't know, Max. Max is the producer, by the way. He's the guy that's behind the scenes throwing up these screens and stuff like that. So, and he's not answering. So now I'm just talking into a vacuum. I'm talking to Max and he's not around. So, all right. So now we got Volund up. Now this is the Vanna chart for Volund. Again, I will define real quick. Vanna is the change in delta as it relates to implied volatility. As you know, Volund is attempting to estimate the total option dealer book. So all of the option positioning that all the dealers on the aggregate are holding is what Volund is estimating, and it does a very good job of it, if I may say so myself. But as prices have dropped, we have seen a lot of put buying. And in Vanna terms, positive Vanna is short puts, which means customers are buying puts and the dealers are stuck on the other end of that. And then dealers use ES futures, E-mini futures to hedge. So the more positive aggregate Vanna you have, the stronger the movement will be for every move in implied volatility. As you can see here, we are looking at around like about 18 billion in Vanna. Okay. Typically, on average, around 25 billion in aggregate Vanna is, or an aggregate movement results in about a 1% move in SPX. So if with 18 billion in Vanna, you would need implied volatility to drop about 1.2, 1.3 points to get 1% move in SPX, which is 42 points or whatever right now. So that's kind of the trend line that we're noticing in Volund. Probably before the end of the year, I'm going to drop a white paper describing all the findings that we have in Volund with all the data that we have, and you'll be shocked. There's a lot of really good correlations in there they're very interesting. I'm a data guy, so I love seeing things that work. Anyway, back to markets. So we have 18 billion in Vanna, right? When the price crosses a strike in Vanna, the Vanna sign flips. And the reason why is because, let's just say for calls, if the call is out of the money and it's say, 30 delta or something, as time goes on or as implied volatility goes down, that 30 delta kind of erodes. It becomes 20 delta, it becomes 10 delta. It goes in a negative direction. If you have a long call and it's in the money, say 70 delta, as time goes on, that delta, it doesn't go down to zero. That delta goes up to 100 because at expiration, if it's in the money, delta expires always at 100 or negative 100 for puts. So because of that, the sign flips on Vanna, and it means that if dealers are hedging, just say, for instance, that one strike, and Vanna flips, then they have to change their behavior from buying to selling or selling to buying. So that's kind of where that magnet comes from. People talk about gamma magnets, but in reality, if gamma was the issue, gamma sign would flip. The dealers would have to have a different behavior pattern, when in fact at the strike gamma is highest. So yeah, the whole like magnet effect is really an implied volatility effect. So now that we've kind of established, defined everything that we're looking at, we kind of saw before on the trade alert that there's a big gap between historical and implied volatility. Historical volatility has not gone up very much, even though the market has come down. The volatility, the intraday volatility has not gone up very much. Yet implied volatility did go up very much. And so now the question you have to ask yourself is there a good reason for it to go up? And maybe there was a good reason, but we're looking forward. We're trying to skate to where the puck is going, right? So you kind of have to make a thesis as, will implied volatility come down, or will things actually fall apart and all these people who are hedging, are they going to cash in, or is historical volatility going to come up? So that's really kind of the question you have to ask. There is a strike over here of 4,000 puts, strike 4,000 puts. This expires in October, October OPEX. I only know that I can prove it, using this, but I'm just going to, just to keep things simple. These were bought when that implied volatility started shooting up. So did these 3,800 Vanna spike. As time goes on, that implied volatility is going to come down a little bit. And on those strikes, especially, at expiration, implied volatility is always 0. So as we get closer to October expiration, they are going to push the price up, assuming, of course, nothing breaks. This strike right here, negative, which would be kind of a resistance, is at 4,300, also expiring in October. But remember, Vanna flips sign if we cross it. So really the big question, if we're going to get a really good vol crush rally, is, are we going to pass? Oh, I got logged out. Are we going to pass the 4,300 strike, right? If we do pass that 4,300 strike, aggregate Vanna is going to skyrocket. And if aggregate Vanna skyrockets, here we go, then that means that it will increase the impact of that implied volatility dropping down closer to historical volatility. So really, that's the big strike to watch. And then this 4,400 right here, which are sold calls, we're going to have to watch that for its sign to flip and kind of slow the market down a bit. So if you're, so my base thesis right now, long term, I'm in the recession camp, and we kind of talked a little bit with Lex and Mark, and on my Twitter at Wiz of Ops. We talked quite a bit about I'm in the recession camp. I kind of think that there will be a recession at some point in time. Like pretty much anybody who's been predicting a recession, I've been early, but I still do feel pretty confident in that assessment. Also in my Discord, a lot of people start talking long term, where most of us are pretty much in the recession camp. But in the intermediate term, at least till October option expiration, and maybe, spilling out a little bit into November, I do think that we can experience a little bit of an implied volatility crunch. So basically, my positioning is mostly bearish, but with a shorter term kind of hedge for that bullish kind of push. So there you go. That's my thesis. That's what I was going to talk about today. Since the cat's away, the mouse can play. And that's what I got. So now we got, Max has got questions available. All right. I feel like J-Pow right now, because I got my speech done, and now I'm going to take questions. All right, Ilya. If 0 data expiration and 1 data expiration are about 65% of the total volume traded per day per CBOE, that is true. Why swing trade anymore rather than short-term trade? Okay. So I know everybody out there probably knows 0 DTE is a reference to how many days till expiration the options have left. There has been so much trading ever since they were introduced, I think in 2022. Every day there is an option expiration in SPX, SPY, and I think QQQ, XSP. You know, all the kind of S&P 500 and Nasdaq index and ETFs. So there are, and because of all of that volume, option dealer positioning on zero DTE options is very important. They, you know, if there's no higher order movement, then zero DTE pretty much rules the day, and you can determine market positioning fairly accurately just by knowing the dealer book on the zero DTE options. So Ilya asks, basically, I have something here that is right most of the time. Why would I trade, you know, longer term? There are a bunch of, that's what you're kind of asking more is about your own risk tolerance, and you're also the amount of time you have in the day. I mean, a lot of us work during the day. I'm constantly, you know, working, making Volin better, or I am working to, you know, with client stuff, or, you know, building out, you know, a lot of things. You know, we're making a lot of improvements, new data, etc. So I don't have time very much to day trade. If I do, you know, I might put like a small trade on, but for me, swing trading is great for my time horizon. The other thing too is that there are some days in which your zero DTE will not work. And that's mainly, you know, like the other day, 2 days ago or so, implied volatility went very high compared to the SPX move. Zero DTE worked okay on that day, but there are a lot of days, like if the dollar goes up, you know, the value of the dollar goes up or down, you have to look at a lot of things that you might want to have core positions in, and then, you know, use a smaller portion to day trade. So, I mean, there are, you know, and also even on, you know, there's a lot of technical traders out there, technical TA traders, and they like to have a thesis on a macro level, or, you know, a larger time frame, and then kind of narrow into a smaller time frame. So, so that's, you know, it really depends on the individual investor. There's plenty of people in my Discord that only day trade, and they're, you know, they're doing pretty well. So I think, so I just really think it's all your personal preference. So, you got another question for me, Max? Being new at this, I would like to understand a bit better how historical volatility and implied volatility are calculated behind the scenes, and that's by MM79. So if you go look, there are many ways that people can measure these metrics. VIX is the most popular implied volatility measure, and there's a, you know, a huge calculation on it on the CBOE webpage if you're interested. Like, you can get the formula for VIX, and you can even make it yourself. With VIX, it is essentially the implied volatility. It's a calculation, almost like a weighted average of the implied volatilities across the whole option chain. And for VIX in particular, it is a 30-day measure. So they take kind of an average of all the expirations that are 30 days out. Then, you know, if you, you know, I personally kind of like the trade alert kind of way, which is look at what the at the money is implied volatility, and then have a measure of skew. So you kind of just have two numbers. You have the skew and the at the money implied volatility. I kind of like looking at it that way. And, but that's, you know, that's kind of my preference. If you're asking kind of more deeper, how is implied volatility even at the money calculated, or any implied volatility calculated? It depends on the model that you have. The option pricing models, most famous one is the Black-Scholes model, which is the first, which always makes it the most famous, right? They have several variables that, you know, measure time, measure the underlying, measure, you know, the strike price, etc., interest rates, and kind of, I don't want to say the leftover, but kind of the leftover is this implied volatility piece that, can't fit in with the time to expiration and the underlying, etc. So they're kind of saying this is like the residual amount that premium that customers are willing to pay in like a supply and demand kind of format. Now to move really quickly to historical volatility, since you're kind of looking at the past, the calculation's a little bit more clear, but there are differences in calculation also in historical volatility. Some of them, I think, like on CME, they calculate the historical volatility by taking the intraday range, like the high and the low, and calculating that through the whole, for the past 30 days. Historical volatility is also done by trading days as opposed to calendar days. Implied volatility is calendar days. So there's a little bit of a disconnect there too. Some, like when you saw that 11 and 10%, that is a close to close level. So basically you take the close of the day before, take the close of the day of, and calculate the historical volatility, average it past 30 days. That is kind of it's what I see the most, and I kind of like that, because there's like a mean reversion kind of component to it that you can really get some edge in if you see that. Yeah, so I mean that's kind of how historical volatility is calculated, and then it's annualized into a percentage like you saw. So that's the annualized percentage that is a result of that calculation. All right, do we have any more questions, Max? Could we get to 4,600 by November OPEX? Sure, why not? 4,600. So to me, that's a bit of a tall order. It depends on what we see in the hedging between October and November. Right now, I kind of am focused on the October option expiration because when Japan did their little yen intervention, implied volatility went up in the October timeframe. It did go up a little bit in the November timeframe, but not that much. So I'm kind of more focused on October, and when we get closer to the October option expiration, I think that I would want to recalibrate and see where we're at. As far as how high can we get in the October option expiration, you saw the technical like Vanna, like I guess definition is the movement of delta for every 1 point change in implied volatility, and by point they mean that annualized percentage. So you saw like before when we had that trading view chart up that we are separated by a good 5-6 points, and the typical is 1 point, maybe 0.5, 1 point. So if we drop by 5 points and we have that 18 billion in Vanna, you're looking at maybe about $100 billion in customer or in dealer buying. That has to happen. So you can kind of take that for what it is, but $100 billion is no joke. It probably maybe 150 points by October OPEX. It's not unreasonable, especially if we pass that 4,300. Probably when the market passes 4,300, it'll probably get to 4,400 pretty quickly. So I think 4,400, 4,450 is a conservative target for October OPEX, but really that 4,300 is really the key number there. So, and also again, that assumes that nothing macro kind of justifies the high implied volatility. I don't want anybody going out there mortgaging their house and buying calls. So, so yeah, I mean, there could be something that happens that actually justifies the implied volatility. That's historically though, that's just not the way things go. So, so that's why I'm hedged bullish. I'm not mortgaging the house and going bullish. So, all right, Max, any other questions? I know you have a step-by-step guide on how to look at vol in first swing. Can you explain just briefly again what that looks like formulating a trade idea? All right, hold on. Let me go to Volland. Let me share the screen. Hold on. I mean, I'll do SPX just to kind of since we've been talking about it, and you know, so there's some more dead air. But I'm gonna take a drink of water while I'm at it. I've been talking a lot. I've been going here for a half hour, all by myself. I don't know if I'm a natural or if I'm bombing. Who knows? All right. Okay, so we're talking here about SPX Vanna, right? And if we're talking swing, I'm looking at October expiration, right? So I'm going to deselect here. I will select all these October expirations. I mean, really, the only one that matters is the last one, this one, the 1020 and 1019. But because, a lot of funds kind of hedge in that area, that 10, that monthly AM expiration. I mean, I guess old habits die hard, right? And there's that 4,000 number. That's, very profound. It's very out there. This 4,300 will be more in December. And I only know that because, I've looked at this, I look at this and try to determine some thesis, but this number right here, and this one too, to a lesser extent. I mean, we are probably going to push up. I mean, 5 billion in just one expiration in 2 weeks is a lot. So I mean, that's kind of what we're going to be looking at. That's kind of the source of the thesis. Vanna, I mean, to be frank, Vanna moves the markets, or moves the dealer hedging more than anything else. More than Gamma, other than zero DTE, more than Charm, more than I mean, Theta is basically Charm with a P&L instead of deltas, and Vega is basically IV to P&L instead of deltas. But dealers hedge to deltas, so we look at deltas. Vanna is always where I start. If I'm doing a swing trade idea, I need to know where the pressure is going to be. As Mark called them, the soft deltas. How is that going to influence dealer hedging? And right now, we're looking at 5 billion in Vanna, and it's only going to grow going into October. So when I look at this, I also have to have an implied volatility thesis. If I have an implied, I already spoke a little bit about my implied volatility thesis. I think it's going to come down. And if it comes down and aggregate Vanna is positive, then we are going to see a bullish impulse. And now this is kind of an edge. Of course, there could be some people that come in and sell. I have no idea what the market's at now. It could be a minus 30. I have no idea. But minus 17. There you go. But I mean, there could be some people that come in and sell that are not dealers. I mean, dealers are about 35% of the total market, but that leaves 65% out there of people, buying or selling, retail, institutions, etc. So this is just like, one piece of the puzzle, but it's a big piece, it's like the whole border, right? So I think that my first thing I do for I get a swing thesis is look at the Vanna and have an implied volatility thesis, right? And that will help me determine where the dealer push will be. Then I can look at Gamma as well. And again, I'm kind of just looking in October here, but you also kind of want to look at all expirations. Excuse me. See, implied volatility doesn't move as much. It moves and it has more of an effect on price than Gamma does. Far out tenors, like a year out, but it doesn't move a ton. So I would look gradually with the nearer expirations and then kind of expand out a little bit and kind of see a macro view. All right, so now that I did that, a lot of these are obviously dealers are short the puts. A lot of dealer or a lot of customers have been buying puts to try to protect themselves from this downdraft. And this is kind of where I start seeing danger points, right? This is when you see negative gamma here, that can be dangerous if, we do finally drop. But if we do drop, implied volatility will go up. So, I mean, there's going to be kind of a counteracting force. And as you can see, I mean, when we were talking about Vanna, we were talking like numbers like 5 billion. When we talk about gamma, we're looking at negative 200 million. This is, of course, per point in SPX, so it's a little bit easier to get, 200 million or whatever. But yeah, I mean, this movement, this kind of chart, gamma chart, is saying that probably implied volatility is going to have a bigger impact right now than gamma. So yeah, I mean, that's kind of what I look at. Which is going to be a stronger impulse, gamma or Vanna? Is it going to kind of offset? And then definitely always have an implied volatility. They call it they say everybody's a vol trader, and that's true. I mean, you have to have an implied volatility thesis in order to go into having a swing trading idea, even if you're just trading with the underlying stock. So, all right, let me go back to Max. How many questions do we have available, Max? I'm going over time here. Oh yeah, I did read Variance Time. I love that. I really enjoyed that. That blog post that Chris had. I even mentioned it to him. It was, it's something that we absolutely need to implement in Voland in our charm charts. We try to actually. We kind of have a small component in it, but we have to do studies to optimize it a little bit. But no, I mean, Chris's that when you start getting in depth in modeling, I mean, probably most of you watching this, probably all of you watching this, are just kind of retail. Not many institutional people are watching, random, Twitter personality Wizard of Ops. So as far as you guys are concerned, it's just something to keep in mind when, you see VIX a little bit lower on Friday and higher on Monday, or seeing, if you're doing an option trade, you sold an option and the day's going by and there's, not much decay on your option and you're kind of getting frustrated. Like, what do I do? What do I need to do to make money on this? Right. It's just something to keep in mind. Like, oh, well, the last half hour is more volatile than the first half hour. So I shouldn't expect decay in the first half hour. So, I mean, for you, that's kind of where I would go. But yeah, so unfortunately, Max is telling me that's the last question we have time for. So I thought I was going to spend 5-10 minutes talking into the void, but you guys had enough questions for me to answer. We're at 33 minutes. Wow. So I've doubled my time. I guess I could clock out now, right, Max? All right. Thank you everybody for watching, and yeah, hopefully next week we'll have Lex and Mark on, and we could all talk about this stuff together.